A lot of Canadians have built their nest egg through real estate, and for a long time, it works. But then something shifts. The portfolios get bigger, the properties get harder to manage, the tax bill grows, and what once felt simple starts to feel heavy. That's usually the point where people start asking a different question. Not, is real estate a good investment, but does this still make sense for me? Hi, I'm Megan Yakabuski from Scotia Wealth Management, and today I want to walk you through some key things to consider when deciding between real estate and investing. Number one, lifestyle. Real estate isn't just an investment, it can be a full-time job. You're dealing with maintenance, property taxes, tenants, unexpected repairs, and ongoing decision-making. It's not exactly a passive investment the way people think it is. For some people, they enjoy doing this. For others, they reach a stage in life where they have other priorities. Maybe they want to travel, they want flexibility, or they just want to have more time to enjoy life. The other situation I see is where one spouse is heavily involved in the real estate management. But I always ask, if something happened to you, could your spouse or family step in and manage it? I've seen a lot of situations where when one person handles everything and they suddenly pass, the family is left overwhelmed. Ask yourself, do you really want to manage all of your properties? Will this strategy be sustainable long term? Number two, the true cost may be more than you think. On paper, real estate returns can look attractive, but what people often underestimate are the ongoing costs of maintenance, property taxes, insurance, vacancy, repairs, and so on. By the time you factor everything in, your return can look very different. When we prepare financial plans for people, we typically use a 4 to 6% annual return on real estate in places like the GTA in Ontario or the Lower Mainland in Vancouver, but a 6 to 8% return on investments. Over time, that difference can really add up. Number three, tax planning. The other part of cost overlooked is taxes. With real estate investing, you generate rental income, which is fully taxable at your marginal rate. When you go to sell, you trigger one big capital gain at once. In investing, you generate a mix between interest income, which on Canadian dividends has a tax credit, and capital gains, which only 50% is taxed. You have more control by putting certain investments in tax-sheltered accounts, triggering losses through tax loss selling when appropriate, and triggering gains over the course of your lifetime to spread out the tax burden to an extent. When it comes to estate planning, if you own multiple rental properties for a long time, the capital gains triggered can push your estate into a much higher tax bracket. Where stocks usually gains are triggered over time, so the underlying cost basis can be much less. I often tell people who own multiple rental properties, selling real estate over multiple tax years and investing in a portfolio often makes sense because you can control when to trigger the gains. During the financial planning process, we can look at years your tax rate might be lower to liquidate real estate strategically over time. Number four, estate planning. Real estate can become complicated very quickly for beneficiaries. Unlike investments, it's not easily divisible, not easily liquid, and often requires decisions under pressure. Depending on your situation, your kids or spouse may have to sell quickly, manage tenants, or figure things out without a clear plan. Compare that to a well-structured investment portfolio, where assets can be transferred, divided, and managed much more easily. If your plan requires someone else to figure it out later, it's probably not a plan. Number five, flexibility. With investments, you have flexibility in how much income you take each year. Most people tend to spend more in the early years of retirement, things like travel, lifestyle, helping family, and then naturally spend less over time before needing more care later in life. So it often makes sense to draw more income earlier before things like RIF payments, CPP, and OAS fully kick in. That way you can control how much income you report each year and stay in a more efficient tax bracket over time. Real estate works very differently. Rental income is generally consistent, which means as those other income sources come in, everything stacks on top of each other. And you may find yourself pushed into a higher tax bracket, whether you need that income or not. So the question becomes, do you want income you can control or income that controls you? Number six, diversification. A lot of people don't think about when they look at their net worth. Oftentimes, they're heavily concentrated in one asset class, one market, and even sometimes one neighborhood. That means your wealth is tied to a very specific outcome. Diversification is about spreading risk across different assets so one setback doesn't impact your entire plan. Investments allow you to do that much more efficiently, across industries, countries, and asset classes. Real estate can play a role, but being overly concentrated can create risk that's easy to overlook. The question of should you invest in real estate or the stock market doesn't mean picking one or the other. Smart investors usually find the right balance between the two that aligns with their lifestyle, plans for taxes, and considers their family and estate. If most of your net worth is tied up in real estate, it's worth stepping back and looking at the bigger picture. If you're not sure about how real estate fits into your overall plan or whether it's working as efficiently as it could be, that's exactly the type of conversation we have with clients every day. Because the goal isn't just to build wealth, it's to structure it in a way that actually supports your life.